Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thanks, Jim.
Danielle, what is going to happen once the COVID crisis is over? Will it be business and life as usual?
Well, I think it's really important to not confuse the catalyst with the cause of the financial strife. So the catalyst here is the virus, no doubt, which has brought an abrupt stop to economic function in much of the world, and that's a huge shock to the income and revenue stream, the cash flow that sort of keeps things alive. But at the same time, underneath that, there's a whole bunch of more persistent issues. So it's not just as simple as let's contain the virus and, find some antiviral drugs that'll help us combat it when it comes back in the fall, and it will come back in the fall probably, right? So, until we get a vaccine, which probably won't be for about a year and a half or something, we're going to be living with this thing. But that is not really the main plot. That is the crisis at hand in health. But in terms of the financial crisis that's going on, this is much more pervasive, right? This is about a decade of credit abuse, of levering up, of financial speculation, of wasting all the seed corn, of, having people undersave and overgamble. Operations in companies not being beefed up with a lot of cash for buffers, but instead being wasted to buy back shares and take on more debt. And it really reminds me of how the credit crisis got started in 2007, if you remember, because the stock market is always kind of do-de-do-de-do. It's kind of like out to lunch half the time. It's not really driven by much to do with math a good amount of the time. There's mostly participants who are just blindly optimistic and swinging for the fences and hoping that it all works out. But in the bond market, there tends to be more math-centric calculations going on. And what happens is now they have been on this epic leveraging cycle in the past few years where low yields have caused all sorts of, magician-like innovations to create. How do you take a low yield and make it bigger, Jim? You magnify it. You borrow money to buy the issue, and that magnifies the yield, but it also magnifies the risk and the downside. And so the world is now coming to this sudden stop in income with the highest debt levels ever in the history of the planet. And it's not just that, right? It's that for example, there's never been a decade before 2010 to 20 that the world got through without having a recession. In 250 years of data, there's never been a decade like 2010 to 20 where we literally got away without having a formal recession in the world. So cyclically, we were already overdue for an economic contraction. And we had this, extended period of add debt and stir, which I've talked about many times. And what happens is people get incredibly complacent, risk-seeking, oblivious, thinking that some big person somewhere has got the market under their control and that it'll only go up. And they've also had this belief system around real estate, again, in the last 10 years, particularly in places like Canada, right? So you had a whole bunch of, talking about seeking for yield, you had a bunch of private equity, family offices, funds, ETFs, like pensions, all piling into the levered loan market, which is this cycle's version of the subprime crisis, right? So the subprime crisis that started in the U.S. real estate market in 2007, the stock market continued to go up for several months after we started seeing all the pistons blowing, so to speak, in the credit market. And I was writing about it at the time saying, wow, if you look at the foundations of this levered system, it's cracking all around, and all sorts of liquidity crunches spreading, cash deficits, runs on, trying to sell illiquid assets to raise money. And the more that sort of happens, it's a very self-fulfilling prophecy. And so now, indeed, one of the things that happened in the real estate sector was you had all these hedge funds and private equity pools come in and buy up properties in the lows of the last cycle. And that's a levered proposition to begin with. People usually borrow a lot of money to buy real estate. And they did that. And then those same instruments were then pledged as security for other loans and other loans and other loans. And people that had margin accounts were borrowing against these already highly levered assets to sustain their spending, to be able to buy, pay for fancy trips, to buy fancy cars, to, buy whatever, art, diamonds. They were doing it all, right? So you have leverage on leverage on leverage. So why that matters is because once the asset price starts to get shaky underneath, then they have to start selling to pay down the debt. And it really is like this, thing that implodes on itself. And we're seeing that certainly in the REIT sector. We're seeing that in, profits were already in a downturn from 2018. Now we've got literally in many businesses zero revenue right now, right? Zero revenue. So what they're doing, of course, is trying to slash costs, lay off people, and as we saw in Canada, they had 1.5 million people file for unemployment benefits just in 10 days in March. We had 6.6 million Americans file for jobless claims just last week. So now we've got, all the liquidity problems in the corporate sector, which have been manifest through a whole bunch of, bad management and things. This would have been a difficult shock to absorb in the best of times, but what I'm saying is we're coming into it with the least preparation that we could possibly imagine. And that's making everything much worse. So the people that are expecting this to be by the summer, we'll get back out in the community and restaurants will open up again. I mean, a third of Canadian small business owners surveyed said that they don't think that they're going to be able to open their business in a couple of months or 3 months whenever this thing passes, because they just won't be able to get from here to there. And, the wage subsidy part that's coming in, absolutely have to support households. But again, here we have households with the most debt ever, right? Canada with the highest debt to household debt to GDP of any of the G7 countries, above 101% coming into this crisis. And you and I've talked about this many times, how this is not saving for a rainy day, folks. This is spending. And so, we're giving wage subsidies to workers to try and support that through small business. But the problem is if a small business has, a sudden stop or zero or next to zero revenue, they're not going to keep people on with a wage subsidy, right, for any length of time, because it just means what happens is that the small business starts going into the line of credit just to function. Even with a subsidy, they're not able to make any net income. And so they just need to lay everyone off and shut things down and then, sell assets where possible. And this is what's happened because there's so little cash in the system. There's been such a high leverage on highly valued assets, as I've said. What people find is that, I need to sell things in order to raise cash. And when everyone's trying to sell the same things, this is why you get these violent moves in the stock market, in the REITs, and the dividend paying stuff in real estate itself. There was a report out this morning on the fact that they think Canadian real estate sales may be down 30% in the first half of the year. So that's likely to have, again, pent up. If there's no one buying and everybody needs cash, that's going to be price suppressing. That's not the kind of thing that gooses value. That tends to suppress prices. So all of this is really a perfect storm. It's across every asset type. It's through the corporate sector and the household sector being the most levered ever in history, and the longest expansion, which is now due for a recession. So the global recession is here. The credit crunch is here. The stock market had its, most sharpest drop ever, falling 30% ever, in history in the just not even 30 days in March. And we do expect to get these bounce periods where you try and get some buy the dippers, because buy the dip has been a very indoctrinated mindset in this very long credit expansion, where every time stocks sold off 15 or 20%, lots of money was thrown at it, and next thing you know, they're rallying again. So buy the dip is still alive and well in the minds of most people. That's why U.S. consumer confidence remains still near all-time highs, and this is with the stock market just off 20% in the U.S. from its all-time high. So I think that we're likely to see some lower lows, and that this isn't going to be a V. This is going to be, a multi-month process, and we're going to see a lot more washout of people who are not able to make their way, from here to there.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Danielle Park. Danielle, with interest rates at or near zero, how does that really help? Are banks going to lend out that low-cost money, or are they just still going to charge what they want to charge?
No, well, this is the effect of a full stop, right? If people, you can make loans cheaper, but when people are already sickened by the credit they have already borrowed, and they have a problem with income, which is the problem, insufficient income dropping, income stopping in many cases. So there is no appetite to take on more debt in that environment, and indeed, from a lender's perspective, a person has to, unless we're in the full-on liar loan phase, which we have had in different episodes, right? In the U.S. subprime debacle, people didn't need income and were qualifying for loans, but we're not quite there in this sort of, widespread anxiety about the fact that banks have a high vulnerability here in terms of their exposure to the oil crash, which is another huge part of this puzzle for Canada. This is not, that's not to do with the coronavirus. That's to do with a wash in supply in the world, and this has been made worse by the fact that there's been a sudden stop in transport and planes and activity. But, the world was already awash in supply. We were already seeing that, and prices were being suppressed. It's interesting because $20 to $25 a barrel has long been our technical target on the downside for crude, for WTI, and in fact we got there right in the last week. Now the question is, and we had Canadian crude trading below $4 a barrel, Jim, last week, which means that basically every barrel of oil in Canada is being produced at a loss. So we have a huge bounce today in the price of crude. Interestingly, we had a 25% rally in WTI and a 50% rally in Canadian crude because Russia and the Saudis are apparently been put together by President Trump to talk about cutting their output by up to 10 million barrels a day, which is a huge cut. But what's very interesting in this is so what they're trying to do is essentially sop up the supply side, right? Because they're almost running out of storage and refineries can't take any more. And literally within a couple of months, they're going to have no storage capacity anywhere in the world. And that's when you get into a scenario of just dumping product. And that's going to be even more suppressant prices. So this is a total disaster, of course, for Canada's oil patch. This is a total disaster for most producers, Russia as well. Like a lot of the emerging market economies depend on selling crude, and they need sort of break-even prices to be, in the 40 and higher range, nothing like 20 and lower. But the point is that they can't manufacture demand. So they can try and sop up supply, try and produce less of it, but they're not going to gain any market share or revenues. And again, this is back to the credit crunch. This is the fact that people need cash flow. Countries need cash flow at every level. So by sopping up supply, you're not going to change that dynamic. You're not going to drive any demand growth here. And I think that's very interesting that with the huge bump in oil today, the Canadian dollar is actually weaker this afternoon relative to the U.S. dollar. So that really tells you that no one's buying this idea that what's happening right now in the oil market is in any way improving the demand side, right? Because if we were supposedly, if this was a bottom for the equity market and, a bottom for the economy, and we were about to see a sharp V, you would see things like the CAD trade higher, as part of this commodities recovery, organic growth story in the world. We're nowhere near there. So I think that people, another interesting stat, I don't know if you noticed, Jim, was Canadian auto sales came out today. They were down by 48% in the month of March. And as you and I have talked about before, one of the products of this consumer credit bubble frenzy mania that went on in the past number of years is that people were able to get cars for next to nothing, right? For either zero interest or over 7, 8, 9 years with all these perks and incentives, and the manufacturers were, putting all sorts of sweetener on things to get people into new cars. And of course, it was an unsustainable trend. And during that, what happened was all the manufacturers and the dealers went out and borrowed millions of dollars to build massive showrooms, right? All over the country. In every major area, you have this, these opulent showrooms that cost many millions of dollars. A lot of that funds was borrowed, and now they're in a crisis as well because they have this sudden stop plunge, in auto sales. And we would have got there with a recession normally because, again, this is a cash flow problem for people, but this has just been magnified by, the abruptness of this stop, but also by the debt that went on before. So it's all these things together that I don't think they're going to clear quickly. This is not like a hurricane or something that knocks out, a business or wipes out a certain area, and then the next day they start rebuilding it. So what you lose in economic activity in the short run, you gain quickly thereafter. This is going to be a much longer rebuild phase. I think it's going to be much more like the bear market we saw in the 2000 to 2003 space, where it was a long, drawn-out affair before things started to get recovering again. And I think stocks, could go down another 25 or 30% from where they are now. So it's not like people should think, oh, well, I'm too late, I'll just hold on and everything will be great, or buy the dip like, I'm being urged to do. I think people need to be super careful here in looking at their cash position and saying, if things go down further, or if things don't recover for several years from here, how is that going to impact my finances? How is it going to impact my financial plan, my retirement plan? It's never too late to review that, because in the scenario I'm describing, I think it's going to be a much slower recovery than people are anticipating.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, is it time for governments to start legislating good behavior by companies, i.e., they were so busy borrowing money for stock buybacks, they didn't save for a rainy day. Should companies have to have some kind of strategic reserve and not be allowed to buy back their shares anymore?
I think it's very simple, really. You can't really moderate, you can't really mandate good behavior too much, but you can put some hard lines on the road. One of them that I've been a big proponent of for the past several years is banning stock buybacks. Up until 1982, for 50 years, they were considered illegal market manipulation. That's because they are market manipulation. When you borrow money or take your cash and buy your own shares to make them go up, it is a financial gimmick. It is not investing in the strength and stability of your enterprise in the long term or innovation in the workforce, none of that, right? So it was a very destructive chapter, and it has been rampant, and it happened in Canada just as bad as in the United States and other countries, to lesser degrees. So it's been horrifying that this amount of waste has gone on, and it has magnified the harm that's now sweeping because of the waste of money that went on before. And if you look at this whole globalization theme that we've had, in particular in the last 10 years, really, if you think about it, the only way that has been sustainable is it did drive corporate profits much higher for most multinational companies. There's no question. They were the labor share of profits was at an all-time low, and corporate profits were at an all-time high. The reason that was the way it was is that corporations were able to offshore labor to cheap countries, make things cheaper, and then sell them back to Western consumption. The only way that Western consumption could continue was if the workers who were now making a lot less money and had less opportunity for jobs in the West were able to borrow money. So this whole globalization, magnifying corporate profits by, borrowing in buybacks, and also by moving labor to cheaper locales, and then having the deficits in income made up by people taking on toxic levels of credit at home. That was really the whole machinery around how this continued for the past decade and more. And if you're looking at what's happening right now, I think we're at a very abrupt turning point for many of those themes. So the whole globalization theme is now about deglobalization, right? We realize how vulnerable we are when drugs and masks and ventilators and so many things that we take for granted in this part of the world are not made here. In fact, they're made in places like Asia. And so we really appreciate, wow, that's a great vulnerability, right? So I think this is one of the things, the shifts here, the secular shifts, that's going to be stubborn and persistent and ultimately probably quite healthy, but it's going to be a bumpy road between there and that, because it's going to suppress corporate profits, this whole process. We have to get more stuff made domestically. We have to get the labor share of income up so that people don't have to go into incredibly, stifling amounts of credit just to try and make ends meet. So there's going to be, more, the other thing is we need to have more accountability so that this whole idea that if you blow up governments and taxpayers make you whole, bail you out, save your bacon, that's been a very long-running theme here, and it's just devastating. No human develops good behavior when they are constantly saved from their own mistakes. And so I think that what you're seeing now is we had, as I say, record corporate and household debt in this last chapter. Now people are turning to governments, they want to ramp up government debt all around the world again. Canada actually federally came into this with, relatively less federal debt, but that's going to be ramped right up now because of all the first of all, the drop in tax revenue, which is typical of a recession, but now these extraordinary, emergency measures which the government is having to take on. All of that's going to be deficit financed, right? Because there's not enough cash in the hopper there either. It's going to be borrowing, issuing more debt to do that. So I think that is the debt defaults are going to spike in the private sector, and I think that behavioral changes in the household sector are going to be just this whole revelation that you don't need to eat at drive-thrus every day, that you can actually work out in your neighborhood or at your house, that you don't have to have these expensive gym memberships. Again, all this stuff that people were buying on credit, I think they're going to realize in this experience that made them very vulnerable. And once you've done a lot less and you've made your meals at home and you've learned to cook a bit, I think ultimately this is where we needed to get. I'm sorry it took a virus to, make people appreciate that was a destructive choices they were making for themselves. But I think this is likely to prod behavior in a different direction. I am concerned about, there's going to be a lot of defaults. We're already seeing defaults happening we've talked about this before, Jim, huge triple B debt, which had gone up by 50% in the last 5 years in the world. This triple B debt in the corporate sector is falling now, to less than triple B, which makes it non-investment grade, which means that there's a lot of defaults starting. The price of borrowing has spiked for many of these companies. I'm talking about quadrupling in 1 month. So that's going to be a big crunch. Obviously, you can't roll over your debt easily when rates have quadrupled in a month. So all of this has knock-on effects. I think we're going to be less inclined to do, work away, travel preferences, all this, student visas, all this stuff is up for sort of revision. And I think this whole idea about working from home, more people are going to realize, more companies are going to realize, hey, I don't need to have all this expensive real estate downtown in different cities. I could downsize that and have more of my workforce working from home. So there's a bunch of stuff that I think is in flux here. And of course, that's not even to mention the fact that, pensions, there was always going to be a day of reckoning here because the ball's been kicked so many times down the road. But pensions alone, the U.S., Moody's was warning that U.S. pensions lost $1 trillion in asset value just in the last month. And this makes funding ratios that in many cases were, half of the money they needed to meet their commitments at best, now less than half by a lot. So we're into another phase here where people are going to have to rethink the amounts they were expecting to get from pensions. And I've been warning about this for a long time. Some other people have as well, because the math is math, and they were pretending that it was something else, right? So you can't sort of lever and gamble your way out of bad decisions. You really need to see behavioral change. And that's ultimately, I think, going to be a very positive thing that comes out of this terrible experience.
Should big companies that didn't save for this, well, it's not just a rainy day, it's a hurricane, should they be allowed to go out of business this time? Did they learn any lessons from the last disaster that happened to the economy?
No, they didn't learn because bailouts were prolific last time, and also because they were allowed to bonus their executives right after. There was no clawback of income received from these reckless policies. None of that happened. And I think that's what needs to happen. I think we're going to have to see a long and grinding episode here to force that kind of change, because it's very ingrained in the politics and in the corporate culture. But this idea that you have to bail out, for example, an industry like the airline, who spent every single drop of their cash flow on buybacks in the past decade, you don't need to, rescue an industry. You can allow an industry to go bankrupt, and what happens is the strong hands then come in, buy up the planes, reopen the operation, hire back the people, that have been laid off from the bankrupt enterprise, and start again. And in doing so, start with much less leverage, and ideally, you attract then people that know how to actually manage a business instead of ones who just know how to add leverage and increase risk. And so, yes, you can support workers. Yes, you do need important sectors, but you don't want to compensate and reward the destructive behavior in the management and the decisions that were made in the prior chapter. So to the extent we get any political will this time to do that, I'm not sure. But I really hope that we don't throw a lot more good money after bad, because we truly cannot afford to do it.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter at House Street. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.